the purchasing power of the US dollar will decline by 75% over 10 years. If that's true, and I believe it is, I'd love to see somebody challenge my arithmetic, it is likely, as far as I'm concerned, that the nominal price of gold reflects the deterioration of the purchasing power of the US dollar. That would suggest over 10 years a threefold increase in the price of gold. Is it going to happen? I don't know, but it's arithmetically logical that it would occur.
I think silver is going to get very expensive. Yes, a lot of people say that silver is going to catch up to gold when the public realizes there's a bull market in precious metals, and they'll go for the poor man's gold, right? Silver. But I'm here to tell you that I think it could be very different. Yes, and we're going to look at the information that I'm getting from very reliable sources that central banks are actually very active in silver as well, which is very surprising.
The accelerating decline in purchasing power across global fiat currencies is reshaping the outlook for precious metals, especially as monetary expansion and political incentives continue to fuel long-term inflation. Structural forces, from record government spending to the expansion of the global money supply, are exerting sustained pressure on the value of currencies. At the same time, demand for tangible stores of wealth continues to grow steadily. In this environment, both gold and silver are increasingly viewed as assets capable of reflecting and absorbing the fallout of ongoing monetary deterioration, with silver showing particular strength as physical markets tighten. Rickrule, a veteran resource investor, and Mario Innecco, a longtime analyst of monetary history, highlight how central banks, sovereign wealth entities, and emerging market nations are beginning to treat silver not only as a strategic industrial material, but also as a monetary reserve component. Their research points to a broad, coordinated trend among countries in Asia and the Middle East, where silver accumulation is rising alongside gold purchases. With India preparing to accept silver as collateral for personal loans and several BRICS-aligned economies increasing physical holdings, the metal is regaining a monetary role it hasn't held for more than a century. Tight supply conditions, persistent global deficits, and intense price action suggest that silver's breakout above historical resistance levels may be more than a short-term move. As government spending accelerates, tariffs redistribute costs to consumers, and global M2 expansion continues across major economies, the long-term trajectory favors assets that cannot be printed or devalued by policy decisions. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Governments and central banks would want to use silver again as a reserve asset. We have to go back to like the 1870s for really the death of silver as a monetary reserve asset, as money as well. It's been very gradual, of course, but back in the 1870s you had the great crime of 1873 when the U.S. demonetized silver. Yes, it was still used as money, as coinage, up until 1964, but it wasn't really legal tender. People could refuse if you wanted to pay a big amount with silver. Gold was, the U.S. went off a bimetallic standard, and I don't think that was the intent of the Constitution. You can still read it, and it says gold and silver will be coined as money. So that was the great crime of 1873. The other thing that I've heard from people that I know, like the Gnome of Zurich, he knows the history as well. He said that after 1871, the Germans, when they defeated the French in the Franco-Prussian War, they were flush with a lot of silver. And the bankers in Frankfurt recommended that the government sell their silver, and that didn't help either. And also during the Great Depression, I've read that the UK, for example, pushed in the Indian people or the Indian bureaucracy that they ran at the time to just hoard a lot of silver. Yeah, silver was kept down for over a century. It was only in the 70s that we saw silver pick up again and actually go to 50 with the Hunt brothers cornering the market towards the end of that decade. But there's also stories that I've read that the Hunt brothers got together with a lot of wealthy sheikhs from the Middle East, and that there was a plan for Texas to secede from the Union, yes, from the United States, and use silver as a new currency. Did you know that Texas is the only state of the Union that became a state through an international treaty? Yeah, Texas was a republic for a while, and then through the Treaty of Hidalgo became a state. And that treaty is renewed every year, I think, on the 1st of January or 31st of December. It's something done automatic. So I'm not surprised then. Yes, I didn't think it would happen, but I'm not surprised that countries in Asia, Middle East, are now going back to silver. Yes, it was back in July this year that the Indian government, their central bank, the Reserve Bank of India, announced that from April next year, people are going to be able, not just companies, but people like us, but in India, they're going to be able to use their silver to collateralize loans that they're going to take out. So basically, India is saying, well, we accept silver as money again, and I think that's huge. And I think India has kind of triggered an awakening in silver. And of course, there isn't a World Silver Council like the World Gold Council that reports how central banks buy gold. Well, when they report to the World Gold Council, right, every month. So when this is going to come out, I don't know. But I'm hearing from people that I know very well, that I've worked with, that I trust, that now, aside from buying a lot of gold in this correction we saw start back in the middle of October, they're buying silver. And when my friend told me that, I was really shocked that they're buying silver in bulk as well. Not just the Gulf cooperation countries in the Middle East, but also countries like Korea, South Korea. So I think this is huge. And if you haven't started buying silver and you're waiting for it to go back to 30 or 40, I think you will be disappointed. I'm not telling you to do it. This is just my opinion. But now you've got the whole of BRICS. You've got China, Russia, India, and all these powerful countries in the Middle East going at it together. There's no way this is going to be able to be stopped like they stopped the Hunt brothers. And that's why I think this teacup and handle chart, which we're breaking out right now, because as I speak here, it's 7:45 a.m. London time. Silver's back above $54. And back in October, the all-time high was $54.62. So keep an eye on that level today. So far, overnight, the high's been $54.33. Gold is doing well as well. We're back above 4,200. As I've said a few times in the last few weeks, this correction will be over when we make new highs. That's the only way. And we're not out of the woods yet. We could see some kind of short-term correction in the next week or two. But the market seems very strong. And why do I think this is happening? Well, there's one thing that any U.S. administration and any kind of Congress, whether it's controlled by the Democrats or Republicans, there's one thing they always agree on, and that's more spending, right? They might put the country through shutdown or debt ceiling and some brinksmanship and crisis. But at the end of the day, they always come together and they give in to more spending. And that's what it's all about. I'm hearing that Trump is going to send $2,000 checks. I don't know to how many people, but where's that money coming from? Well, it's coming from the tariff tax. Yes, it's a tax. It's not Chinese companies paying the tariff. It's U.S. companies that import goods from abroad. They pay the tariff. And eventually they'll pass that cost on to the consumer, American consumer. And who receives the tariffs from the importer? Well, it's the U.S. Treasury. So by sending this check to people, it's not really from other countries. It's like they're taxing the American people, and it's a gimmick. They're saying, "Oh, we're giving you $2,000," but they've taken already $2,000 from you through tariffs and through higher prices. So that's what's going on, and I think that's why we're going to continue to see the dollar go down. Not just the dollar, but also all of the fiat currencies. Governments keep spending, and someone sent me this chart here of global M2, and it's not just the US that's growing M2 money supply, but also China and the EU. There's no stopping these people.
Growing pressure on global currencies is reshaping long-term expectations for hard assets, especially as structural deficits, rising debt loads, and persistent inflation erode the real value of money. The scale of liabilities facing major economies has created an environment where purchasing power continues to deteriorate far faster than official indicators suggest. This widening gap between reported inflation and personal cost of living realities reinforces the appeal of assets that operate outside the reach of monetary dilution. As financial conditions tighten and bond markets begin to resist policy intervention, concerns about currency stability and long-term solvency are becoming increasingly significant. Hard assets with fixed supply profiles naturally attract attention during such periods, particularly when real interest rates remain negative and savings struggle to maintain their purchasing power. At the same time, sectors tied to essential commodities appear deeply mispriced relative to long-term demand. Underinvestment in energy, mining, and resource production has created an imbalance between current valuations and future supply needs. While short-term liquidity trends dominate headlines, the structural backdrop points toward a landscape where tangible assets, cash-flowing producers, and inflation-resistant stores of value offer stronger resilience. As global currencies move toward higher volatility and long-term depreciation, the case for strategic exposure to tangible assets strengthens across multiple timeframes. Let's get back to the interview.
My belief is that because of the size of the on-balance sheet and off-balance sheet liabilities of the U.S. government relative to the size of the U.S. economy, that the purchasing power of the U.S. dollar will decline by 75% over 10 years. If that's true, and I believe it is, I'd love to see somebody challenge my arithmetic, it is likely, as far as I'm concerned, that the nominal price of gold reflects the deterioration of the purchasing power of the U.S. dollar. That would suggest over 10 years a threefold increase in the price of gold. Is it going to happen? I don't know. But it's arithmetically logical that it would occur. The second thing is that gold traditionally has done well, reflecting that fear in real interest rates. If you believe in the CPI, you believe that the deterioration of the US dollar is proceeding along at 2.9% a year. The problem is that the CPI is a flawed index. When I look at the basket of goods and services that I consume, the deterioration of the US dollar relative to what I buy, what my household buys, is declining in purchasing power at about 8%. So if you buy the US 10-year paying 4.1 in a currency that's declining by 8, what that means is that you're losing 3.9% a year compounded. There is nothing that could make you more concerned about the maintenance of the purchasing power of the dollar than a guarantee that your savings cost you 4%. Hence, gold does well. There's a lot of room for surprise. Yeah. The mining companies have also been trained to use fairly conservative price forecasts. When people's earnings forecasts are based on $2,750 gold and $3,000 gold, and they're selling the stuff for $4,000, there's pretty good earnings surprises. And earnings surprises drive share price escalation. I think there are good as opposed to bad surprises baked in the cake for at least 2 more quarters. People pay more attention to liquidity than they do solvency because people hate arithmetic. If you look at the S&P 500 in the period 2000 to 2025 and your denominator is gold rather than the dollar, the S&P 500 has been in a bear market for 25 years. If your denominator is fraudulent, then you see us in a bull market. I mean, this is really pretty simple arithmetic.
It is.
I have, as an example, I've maintained liquidity in US dollars, but I've saved in gold for 25 years. And when I look at the part of my ledger that's constructed in gold, I'm struck by how cheap things are. Energy's cheap, food is cheap, housing's cheap. What I use as my denominator, the US dollar, things are expensive.
Yeah.
The Fed is actively participating in the short end of the curve. Since 1992, when they've participated in the short end of the curve, they've been able to bring the long end down. People have played the time spreads. Mm-hmm. What's happening now is that despite their efforts, the long end is going up. That would suggest, doesn't prove, but it would suggest that for the first time since the Clinton administration, the market is beginning to reassert control over the long end of the curve. And that must scare the hell out of the Fed. I think that the next 10 years sees a period of multi-currency volatility. I don't think that the US dollar does poorly relative to other currencies. I think the purchasing power of the US dollar in an absolute sense is going to be disastrous. I mean, I think that we re-enter what we saw in the 70s, where according to the US government, the US dollar loses 75% of its purchasing power. I don't think the US dollar does badly against the euro. No. Or the Canadian dollar, or the Australian dollar, or the British pound. I think it is absolutely as opposed to relatively bad, but I think that we're coming into a period very similar to the period 2000 to 2006, multi-currency turbulence, multi-currency variability. Right now, we're seeing a period where although the US dollar is absolutely weak, it's relatively strong. I'm not sure why. Yeah. I suspect it isn't because of the strength of US so much as the weakness of our counterparties. The peak oil demand occurs in 2030. Peak oil demand doesn't occur in my life. For the record, I'm a healthy 72-year-old. I don't think it occurs in your life, no. Which means that when people do net present value calculations on oil companies, they throw out the back half of the demand curve. I think that the oil industry is selling at a 50 or 60% discount to net present value today. But the second part of the equation is that the oil industry is underinvesting in sustaining capital by about $2 billion a day. When you do that, it doesn't affect your output in 26, maybe even 27. But 28, 29, it affects it dramatically. So I think that the industry is selling at a 50% discount to what it's worth, and I think what it's worth doubles. So I'm talking about buying a 3 or 4 year double at a 50% discount and getting paid, depending on the stock, between a 4 and a 6% dividend while I wait. In other words, my time value of money, which is traditionally my bogey because I'm always early, doesn't exist because of the dividend yield.
It's covering here.
These are stupidly high quality companies. I mean, I'm not talking penny dreadfuls here.
Yeah.
The long-term trajectory of global currencies suggests a sustained decline in real purchasing power as governments continue to expand their debt obligations and accelerate the creation of money. Structural imbalances across fiscal policy, interest rates, and commodity investment are converging into a cycle where traditional measures of value struggle to keep pace with the rapid deterioration of monetary conditions. With liabilities growing faster than economic output and real-world inflation exceeding official benchmarks, the gap between nominal pricing and genuine purchasing power continues to widen. Meanwhile, chronic underinvestment in essential industries, particularly energy and raw materials, sets the stage for significant repricing as supply fails to match global demand. The combination of tightening financial conditions and weakening currency fundamentals is ultimately shifting the balance toward assets with durability, scarcity, and real utility in the years ahead. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.